Good morning, ladies and gentlemen. I've just realized the last time I did a video was actually December the 17th, so Happy New Year first of all. But very little has actually changed in effect since December the 17th, and we will discuss the reasons for that. The model score really is oscillating between, 15 basis points, which is not significant, and the market, having pushed to unsustainable levels, has slightly come back. But everything is absolutely normal. Nothing is outside of the normal parameters, especially if you look at normal distributions of what the market tends to do in risk on. And then if we have a look at the spread aggregates, and especially the stacked volatility, it is still coming down. So this is telling me that this is not any kind of new trend down in equities. This is just consolidation. Indeed, since December the 17th, the bond market has done very little indeed. And let's discuss the reasons for that. We were told by the Fed in no uncertain terms just before the FOMC, by the Waller, event, discussion, presentation, that basically they're looking at real rates. And if they're looking at real rates, the only thing that matters is what CPI or core CPI is. What the economy does, and while earlier we used to say that what the real economy did and what the employment situation was mattered, because they wanted to have a higher rate of unemployment to basically reduce demand. Now they're telling us, well, we don't really need demand reduction, we just need a continuation of inflation down towards a sustainable 2% target. Well, if that is the case, NFP doesn't really matter anymore. It can be on the high side, and all the real economic numbers can be on the high side. All that matters is which way is inflation going. So let's have a look at the twos. This is the candle that we did on the day of the Fed, and basically we broke the previous lows and continued a little bit because people were out of position, and now all we did on Friday was basically return to the level and backed off. Exactly as I wrote to you on Friday morning, I don't think that we're going to break this level until and unless CPI says that we're no longer on that sustainable path, and CPI is on Thursday. So as you can see, the twos are completely stuck in this range. I think it's going to take a high CPI number to actually break this 455 level. And if we break that 455 level, we're going to go very quickly to 475. So the volatility is only going to come on a high CPI, core CPI number. Unless and until we get that, we are in a waiting game, and just we are waiting for when they cut. And if the market is waiting for when the Fed cuts, it's unlikely to push yields up. It's likely to maintain yields in a narrow range, waiting for it. And then if we get on top a low, some very cold number for the real economy, it's going to accelerate the trend down. But what to me is very noticeable is that the short ends, 2s, 3s, 5s, don't want to know about going higher. So this is the 5-year, exactly as I said, at the level that I said it would stop. It stopped and reversed. While in the 10s and 30s, the story is slightly different. It is coming back much less in 10s, and it's coming back much less in 30s. Now that could have something to do with the fact that we have 10s and 30s auctions this week. 10s I think are Wednesday and 30s are on Thursday. So people would be setting themselves up for them. But really the story is that this yield curve wants to steepen. So let's have a look. 2s, 10s. You know, it just is unlikely that we sustain these levels up here around 47 to 50. And really all the pressure to me is going to be on the downside unless the Fed, not the Fed, unless data shows us that CPI is no longer trending towards target or has stopped trending. Economic numbers are really not going to do it. They would have to be very strong to cause now some kind of flattening. To me, the trend now is steepening, and the only question is where do you put on steepness? So now these are 2s, 30s. I just think that the whole trend from now on is going to be towards steepening, and if and when we break this level around 0, it's going to really accelerate, because let's change this to we will have a longer term picture. To me, the trend all this year is likely to take us down towards this 31 level, and that is 31 positive if you think of a positive yield curve. So to me, there is another 50 basis points of steepening that will happen at some stage this year as inflation moderates down towards the 2% target, the Fed starts its cuts, and the longer end can't really follow. Why can't it follow? Well, because the term premium is already negative. We have a negative 15 to 20 basis points term premium. So I really can't see how 10s and 30s are going to be able to follow what the Fed is going to do, and all the pressure and all the buying is going to be from an extension from where people have money, i.e. the money markets, i.e. the 3-month bill, and they're going to put it where? They're going to put it into 3-year, 5-year, 7-year, not so much the 30-year, because there will be a lot of duration issuance at some stage this year. Janet Yellen's going to have to pull that trigger. So over time, the tendency is just going to be for a steepening back towards these levels, and really being stable at the levels that we were from 2018 all the way to 2020. You know, that seems to be a reasonable place for the yield curve to be in future. And this theory of mine that 10s and 30s are really going to be doing very little compared to the short end is basically borne out in TLT. I think TLT is in a big range, and TLT is completely to be avoided this year. I just don't see what is going to make TLT rally hugely unless it's a recession and unless it's going to be very weak real economic data on top of CPI at target. CPI at target changes the curve. It does not change the level of 30s as much, nearly as much. For TLT to rally and for the long end to rally, you need real economic weakness. Because don't forget, the supply is still there. The supply can be ramped up, and actually probably should be ramped up at any time by Yellen, but we will discuss that towards the end of this month. So leave TLT alone. What you need to concentrate on is the belly of the curve that has some duration and is enough to give you some price movement, something like basically 5s, 30s. And to me, this chart, especially if we try to change it to a weekly chart of 530s, is an accident waiting to happen at some stage. When we start breaking these levels and we actually close below them on a couple of weekly basis, I think we can come down here quite reasonably fast, within 2 or 3 months. Everything tells me, the fundamentals, what the Fed is saying, what is happening from real economic data, everything is telling me that 30s really aren't going to go anywhere, and all the pressure is going to be at the short end. Let's have a look at Germany, and much the same thing applies there. I think if you see 268 in Schatz, that's going to be a good place to go long. But really, it's the Bobble and the Bund which are interesting. The Bobble did exactly what I thought it would do on Friday. It just closed this gap and reversed, but not very much. It's waiting for inflation as well, and it's going to remain in this kind of range. The Bund is actually looking quite attractive at this 221 level. I think it's going to be very difficult for it to start breaking up very much. So we will try to play it from the long side, especially on the Bobble. And the 30s are really not doing very much at all, and I think they, together with US 30s, are going to be left behind in this race down. The 10s in France, to me, are going to be very interesting at 282. We get there in the first 2 or 3 days, and I think it would pay to go long of them even before CPI and take a punt on it. So I quite like those, and everything else really is completely stuck. If we have a look at Italy, Germany, I don't think that is going anywhere for the time being, although I think that Italian bonds are going to get bought when it becomes clear, or if it becomes clear, that the economy is also weakening, because they've got a high yield and people will try to shift towards higher yields. But that is a story for another day. I don't think anymore that we are going to break these levels. We are not in this period. We are probably in this kind of period, because I do think that the economy will weaken at some stage when we least expect it, probably. So really, I'm not a seller of Italy anymore. Differentials between the US and Germany are absolutely stuck. This is the 2s, this is the 5s, and this is now the 10s. Completely stuck, as you can see. We are just basically bumping our head against this 190 level, and between 182 and 190, i.e. going absolutely nowhere. And it's going to be interesting to see if we get a signal from this at some stage. I find it difficult to believe that we're going to break down too far. I don't think that, and I'm talking about probably all year, we're going to go below this 152 level. But I think there will be some value in the signal when these levels break to the downside, or if they start breaking to the upside. It will definitely tell us something, but what is going on at the moment, and which I think is important, is that both markets are waiting for signs from inflation. And they're basically trading in parallel within a 10-15 basis point range. And that makes sense to me. And therefore it makes sense to me that we are going to get a signal when they break one way or another. At the moment there's nothing to see, but what I suggest is that you make up these charts and you wait and you set an alarm at these levels that I have marked, because breaks will mean that something is going on in one relative to the other, and it'll be interesting to see what that is and what the signal, the fundamental signal is. I find it difficult to believe that anyone can out-hawk the Fed, and I find it difficult to believe that the Europeans don't need to cut rates more than the US does. Therefore, I would expect the signal to be on the upside. But you never know, there could be a first feint down to the downside, and that would be interesting because that would give us an opportunity to fade it. This is now a daily chart of Germany against JGBs, and I'm showing you this chart because I think it's going to be very important for FX this year. So we are correcting the move that we had from October, so that's a whole quarter's move, but we can see that we've got some very, very tough overhead resistance around the 180, 181 level, and we're now at 157, so that's 20 odd basis points. It's very difficult for me to see why German yields should be going up in terms of Japanese yields relative to Japanese yields, and I think anywhere near these levels is going to give us a very important signal, but a signal in FX as opposed to the interest rate differentials here. This will move as well, but FX will probably move more, and it'll give us a timing for what could be a Japanese move. Bear this chart in mind, it's going to be important later on in the year and should give us a very good FX read. And here is what I'm looking for. This is Euro Yen. As we can see, when it broke this level, it just bounced off the 200-day moving average, which keeps on acting as support. Now, if we get this move back up towards 180 that I just suggested is a possibility and a very good risk-reward level, that would tell us that over time we will probably be somewhere around here, 181, 182, and that will be our opportunity to resell. The risk reward there is going to be very, very good because we will have a very good level to play against in the differentials, and when the market sees these differentials, it should really be ready to turn. I find it very difficult to believe that we are going to go through here, and that's 162. I'm sorry, it's not 182, but something like 161, 162. When the market returns to these levels, I think the odds are going to be very, very high that we return down to the 200-day moving average. And then if the differentials keep on going, that will be the opportunity to break it. So that is the kind of signal that I'm looking for in Euro Yen. Apologies for the wrong level, a return to this level, 162, 163, and from there on a complete collapse through the 200-day moving average as the Bank of Japan then tightens. I have very little to say and very little that I want to do in Dixie. It seems to be completely stuck to me. And as I showed you, the relationship between the euro rates and US rates is also stuck. And therefore, I just don't see anything to do but technically trade it between this 102.80, 103 level and this 140 level. I don't think it's going to move anywhere in the very short term for the very same reason that the spreads are stuck. We are waiting to see who can out-hawk the Fed, if anyone, and I just don't think anyone can. And in that case, I think at these levels, it's a better buy than it's a sell at these levels, because longer term, if nobody can out-hawk the Fed, the dollar should be supported. I find it very hard to muster up any enthusiasm for gold because inflation is declining, commodity prices are weak. I just don't see why anybody would prefer to now pile into gold longer term as opposed to earn, I don't know, 2% real. It just doesn't make any sense to me that we are going to start rallying greatly in gold, in which case we're going to remain trading around this 200-day moving average, which is around the 2010 area. I just don't see any kind of impetus to make big money switching to gold at the moment. Now, data will change and the impetus will come, either up or down. But for the time being, I think it's a best left alone, and really just like the dollar, it's trading in technical ranges, 2100 to the upside and this 2010 area to the downside, and that is all you can say until it starts breaking it, and unless we can identify a real fundamental trigger, I would just trade those ranges and for the time being leave it alone. Don't force a trade. I'm not going to force a trade in gold because I just don't see the fundamental attractiveness of it at this very moment. Now, that will change, but for now, nothing. DBC is weak. This is now lower than we were at the when the Ukraine conflict broke out and we had this spike. It's now lower than that level. 2175 is a very important level and it bounced off it. I do think that for the next couple of weeks the risk reward is actually to be long for a return to around the 23 level, 23.30. So I'm not going to short it, but I'm just remarking that it is weak overall. It's just not a market which inspires a huge load of confidence to the upside, and we are only going to be trading 3, 4, 5, 6% ranges, which in commodities is not a lot, right? So that also tells me that the likelihood of bonds needing to back up too much is really not all that great. And if that is the case, then we know that the volatility in the bond market is not going to be as great as what we're used to. The reason why I think DBC is more likely to trade up next week rather than down is that oil seems to be on this 200-week moving average and finding it very difficult to close below it. So it's being supported. And also the 200-day moving average is stable up here. So really the odds are that at some stage we test it around the 77 level and then come back. And DBC has a lot of oil components. I find it difficult to believe that this chart is going to break down just yet or very quickly. It's more likely to be in a prolonged period of sideways between, this level just below 70 and 76, 77. So I'm more bullish than I'm bearish, but I also recognize that we're not in an impulsive period, and therefore it's going to have very little long-lasting effect on bonds. And I really don't think that commodities is going to be the place to be, apart from a quick trade in DBC and a quick trade in oil. And that tells me that bonds can steepen, the yield curve can steepen, but don't expect too much of an upside move in long-term rates because the catalysts for them are not there. New month, so always good to have a look at the monthly chart. This is a monthly chart of the DJI, and as you can see, very little upside, but DJI is the one that's done absolutely nothing last week. So while Nasdaq came off 3% and the S&Ps came off 1.3, the DJI, the Dow did, nothing, 0.5, which tells me that it's the financials, and you are going to get the bank earnings starting on Friday, and JPM has been on fire, and basically tells you that the bank earnings are going to be just fine, pretty good, and no reason to sell the banks. If there's no reason to sell the banks, there's no reason to sell the economy. If there's no reason to sell the economy, then earnings are going to be decent, right? They're going to be more or less what the market expects. My problem with equities is the market has priced in so much in terms of 2024 and 2025 earnings increases that I think that is unrealistic. 12% for 2024 and 12% for 2025 is unrealistic unless the economy starts reaccelerating again. And if the economy starts reaccelerating again, I don't think that long bonds are going to like it, and therefore the multiple is likely to be reduced. But for the time being, I just want you to show you the difference between the monthly charts. You will see that, this is not a bear market chart. The really big support that I don't think is going to get broken is going to be down here around the 4,600 level. That's going to be the big support. So anywhere in the 4,600s, i.e. below 4,700, I don't think the risk reward is there to sell it. And if that is the case, I just don't see that the volatility is going to be very high. Now, if we look at NQ, that is where the rotation has been going on. Here is the chart, and let's try to enlarge this. So this is also in big support, but the really big support is going to be down here. Is going to be around this 15,800, or just around the 15,900 level. I find it very difficult to believe that we're going to break through there, and I think the risk reward would be to buy it down there, but we will see. I just find everything very difficult to sell at the moment, and I don't think anything in these equities is anything but a short-term move, and basically the market digesting this enormous move that it had between November and December. I mean, we're talking about 14.4 to 17,000. That needs a little bit of digestion, and it might take some time. And that's why I don't think there's anything to be done. And I'm not going to show you anything daily or short term, because CPI will tell us all we need to know. And, we wait for CPI and then we go. I wanted to show you a very quick chart of the Nikkei, because it's the one market which seems to be coming off the least and consolidating the most and getting ready to break out. I think a weekly close, above, let's call it 34,000 or, 33,900 is going to give you a decent signal that it's going to lead higher. I don't expect it for the time being, but, I just want you to be aware of it and mark it down, because I think anything above 33,900 on a weekly close is just going to show you that this market has impulsion still. I don't know what would cause it, but I do know that the charts of EWJ to EWG, so Japan against Germany, are looking, to go higher. Even SPY, EWJ, so the SPY against Japan is also looking to go higher. So it seems to me that the upside pressure, if there is any in equities, and CPI will tell us, we don't need to do anything before then, seems to be in the Nikkei rather than anywhere else. Why that should be, I have no fundamental idea, and therefore I'm not really going to trade those spreads. But have a look at those spreads and have a look at what the Nikkei is doing, and if it starts breaking up, it's a signal at the very least for you not to short any other equity market, because it's just going to drag them up. And finally and lastly, a word about vol. Why would vol rise if long-term rates are really not going to go anywhere now, and if all the move, as I explained earlier, is going to be a real rates move from the Fed funds going lower to keep the real rate of Fed funds constant, and therefore it's the 2 years, the 3 years, and the 5 years which move, and the longer end, because it already has a negative term premium, does not very much. If that is the case, and that is the fundamentals that we are facing, then the move volatility in bonds is not going to be very high, and that really should tell us that the volatility in equities is not going to be very high. In which case, we are in this period of descending 200-day moving average, and now turning 200-day weekly moving average, which to me means that any spike up towards these, the weekly moving average, and any spike up to the daily moving average is a correction, and it's not the start of some bear trend. Triangulating everything that I see and the narrative for the fundamentals that I have, I just can't see that this is a period of high volatility. If I can't see a period of high volatility, then I can't see very deep retracement in the equity markets. Why would it become a period of high volatility? Only if the narrative that inflation is heading back down to target all by itself, without the need for any kind of corresponding weakness in the jobs numbers or in the real economy, that would change everything, and then volatility would really pick up. Because then the story that certain governors have been putting about, that we might, we're leaving an option, the option of more rate hikes on the table. Well, of course they are, rubbish. But what I'm trying to say is that then that would become a reality, okay? Because then people would start saying, oh, we might need another rate hike. And then volatility would really pick up. But until and unless that happens, and that I think is going to happen only through CPI numbers not being what the market expects. If the CPI numbers now, and especially the core, of course, they start turning and they start becoming higher than what the market was expecting, then we can have high volatility. Until and unless that happens, I don't think we can. What is actually remarkable is how little all these levels have changed since the 17th of December. I don't think there's anything to do before CPI. I think all these levels are going to hold until CPI, and unless CPI is hot, because I think that a CPI in line with what the market expects is going to be good enough to hold all the ranges. It's only if it's outside that we start getting volatility, and basically we wait for the CPI, and then we will be able to trade with much more certainty. Thank you very much indeed, and I will tweet to you tomorrow.